and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be doing the weekly recap. We're also going to be talking about a couple of highlights of the week, talking a little bit about Disney, CenturyLink, entertainment properties, Colgate, and some Time Warner, and AT&T. Basically looking at a couple articles that took place this week. Of course, I'm a holder of just about every single one of these stocks, and I also, well, except for one, and I purchased a stock this week, so I'll talk a little bit about that, and kind of going forward how I will be writing up articles. Of course, this will be adjusted as I progress here. So just really quickly, recap of the week. So this week, November 6th through the 10th, the S&P 500 moved down 0.21%. Year to date, it is up 15.34. Now, I was expecting a pullback sometime. Indexes have been hitting, record highs. Dow Jones, S&P 500. These have been on fire lately. So, onto the Dow Jones, a 5-day change, negative 0.5%. So not too bad. Monday, Tuesday, Wednesday, they were up minimal, hitting, record highs again. And then there was some pullback Thursday and Friday, which is totally normal. No need to sell out. It's nothing crazy. NASDAQ had 3 out of the 5 days positive, a 5-day pullback of 0.20%. And then year to date, they are up 25.41%. So NASDAQ is still in the lead, but Dow Jones is catching up here and there. And then the S&P 500, I don't believe that'll catch up with the Dow Jones anytime soon. So on my Facebook page, I always write up, or I try and write up. I went through a transition last week, or I don't know what the heck happened last week. Oh, I was doing my computer. I was building my brand new computer and getting it set up. So I'm on my new computer now, recording from it. So here I have my weekly recap of 6 through 10 November. S&P 500, Dow Jones, NASDAQ all went negative. My F&I portfolio was actually positive for this week. I had an increase of 0.18%. So S&P 500 and the Dow Jones, I always include those in my snippet just because my portfolio is aimed to try and beat those indexes while still getting higher dividends. My portfolio, I've beat the S&P 500 and Dow Jones week after week, except for the last 2 weeks. I did not beat them, but my dividend yield is higher than a 4%, so that always helps kind of offset some stuff. So that was in there, and the main ones that took my portfolio down were AT&T and CenturyLink this week. AT&T with the Time Warner got kick, and CenturyLink's been taking a couple hits in the gut. So on to some of the news that's out there. So Disney, this is one that I was reading into. I've actually been looking for a good opportunity to buy into Disney. Disney has a huge, I've talked about it on my actual website a little bit. Disney owns so many services products out there in media. They're a media giant. And I don't know if this will affect their stock price, but Disney did shut down 2 of their cooling towers after some Legionnaire disease was stricken, and it was mainly some older couples, like the age ranges were 52 to 94. One of them was, I believe, a actual worker there. I think it's in here somewhere. They talk a little bit about how the remaining 3 were Orange County residents who did not visit the park but lived or traveled in Anaheim. So not sure. So maybe it wasn't directly dealing with Disneyland, but it talks about the other 3 residents did not visit the park but lived and traveled to Anaheim. So this is actually Anaheim theme park. So okay, so 10 were hospitalized and 1 person with additional health issues did die, according to the health officials. Pretty crazy stuff. I'm not sure how it'll affect. This actually took place on November 11th. This article was written, and that may affect the stock price going into next week, which would be a nice pullback. Disney itself has been on a bit of a downwards trend, but they've actually been starting to pick it back up just because of the news that they're starting to pull back out of Netflix, and really nice growth there. So I might jump into the stock. It has a very decent PE ratio, dividend yield, their payout ratio, all the areas that I like to look for in a company and have consistent dividends. Now, CenturyLink, they released their earnings, their quarter 3 earnings. They actually did not meet their earnings per share, and they missed their revenue. So earnings per share, they only missed it by 0.01, which is actually not too bad. The revenue they did miss by over 30, I think it was 35 million. This says 30 million, but into the actual description, they missed out by about 35 million. Some of the areas in here that I wanted to cover was just their merger with Level 3 finally completed. So as you know, last week we completed the acquisition of Level 3, so this was something I was waiting for, their completion of their Level 3, because I believe going forward they're going to be turning CenturyLink around with this whole merger. Management from Level 3's coming in. Level 3's been managed much better than CenturyLink has been in the past, and CenturyLink is trying to focus more on loyalty and building customers, offering customers a broader range of services and solutions. They're very in-depth in fiber optics and such. I don't know where it was in here, but I know, they have a lot of customers that use fiber. So here they have over 100,000 fiber enabled on net buildings globally. Well, actually, they're actually in 60 countries and serve nearly 5.8 million homes, so quite a bit of customers. So they have been increasing and increasing. Of course, I saw some CenturyLink ads come out that if you pay a certain price, you get it for life. So they're doing a bit of marketing, and I will be holding on to CenturyLink. Even if they do cut their dividend, which is around 13% yield right now, I don't mind it at all. If they could cut it back a little bit to get into a yield of around 4 to 5% would definitely be fine. I would still hold on to it then, just knowing that their earnings is going back into the company and building it up in order to kind of grow it out a little bit. Another one that's inside of my portfolio is EPR, Entertainment Properties Trust, and I don't know if it was actually Properties Trust, but Entertainment Properties, and they missed their revenue or their earnings per share by 0.09%, but they beat their revenue by $19.17 million. So very good work there. This is one that's, it's actually down in my portfolio, I believe. EPR, those are two, and they've actually been down, but they're actually really good entry points at this time. Colgate just finished off with a lawsuit that's kind of going on with their asbestos, and one thing I was, they decided to just kind of pay off the lawsuit. So when I was kind of reading into it, they decided to just not go to trial, and they decided just to kind of pay it off, and they've done this in the past. So they know that this specific, so it's claiming that a talcum powder product caused a woman to develop mesothelioma, a fatal lung disease related to asbestos exposure. The financial terms were not disclosed, so they didn't give out how much money, how Google was fined by the European, and they don't actually talk about what the financials will be here. But Colgate decided to just resolve the lawsuit by just paying out a certain amount in order to avoid trial, and this has been done in the past by both Colgate and Johnson & Johnson. Well, first of all, Colgate has had more than 170 cases of the accused of selling powder containing asbestos, and it has only settled 43 of the cases year to date, whereas Johnson & Johnson is facing more than 5,500 claims of the iconic baby powder causing ovarian cancer in women. So that was something that was kind of interesting, and who knows, I've probably used Johnson & Johnson baby powder for multiple years, and different generations I've used it. And Time Warner and AT&T merger, this thing got kind of kicked this week. They kind of nulled it out unless AT&T is able to meet certain conditions. They're supposed to sell off like their CNN portion, and so shares of Time Warner are plummeting on the news of AT&T buyout offer will be denied by regulators unless major conditions are met. So this stock here, Time Warner, was at like $93 in the 90s range here, 94, 95. It was like $93, $94 last time I had looked at it, and it's actually fallen down into the $86 price range, $88, $86. So that is a huge drop. And with this acquisition kind of going on between AT&T and Time Warner, I know this article focused mainly on buying Time Warner. looking for a good entry point. He placed a couple of orders which average around $88, and that's still a pretty good entry point, especially with the whole merger going forward and what could be the growth or gain in that type of situation. So this is actually a pretty funny article. I like that on Seeking Alpha. They have a lot of memes in here, so that awkward moment when you start to look like the bad guys. They have a lot of memes in there. Of course, they use white charts, so I thought it was an interesting article. And that is it as far as weekly news. And then I did make one stock purchase. That's a bit too large. Just go pull back a little bit here. Right. We'll just leave it right here because I actually recorded my name here. So I did make one new stock purchase, the New York Community Bank, which is ticker symbol NYCB. So going forward, every time I buy a stock, I'll kind of write up an article, kind of go over the description. It was a financial sector in the industry, savings and loans. It's basically a banking company, and I have a little description here of where they're located at and what kind of products and services they've offered in the past. And I talk a little bit about their ex-dividend dates. Now this is a 2, 5, 8, and 11 paying stock. So February, May, August, November. Their ex-dividend date and their pay dates fall into the same month. Now when I was researching the stock, I took a look, how I normally do when I kind of scan through. I take a look at their price, their dividend yield, and their price to book value. And their current dividend yield was 5.42%, which currently meant that it was undervalued at the time. Their stock price was sitting about $12. It did bounce to about $12 on Friday. I picked up a couple additional shares there, and their price to book value was 0.98. So in a case where their stock price is actually below their book value of 0.98, so a 1.0% or 1.0 book value would mean that you're paying the exact share price for what their book value is worth. It'd be 100% across the board. This is actually, you're paying 98% for the share price for actually what their book value is worth. So when charted above, it shows that the current stock has a higher yield to price, which would indicate that it is undervalued at this time. The stock is under in the current S&P 500 PE ratio, which is 26ish. It is above the 60%. It is above the 60% payout ratio where I'd like to see, and it's had dividend growth for 0 years. This price to book value is 0.98, which is lower than the 3.0 standard where value investors would consider a value. Now, some additional things that I looked at was their bank revenue. Has their revenue changed in the last 3 to 5 years? And it's been actually positive. Has their free cash flow changed in the last 3 years? And their free cash flow has been positive. And then their net income has kind of begun growing up. And I started at 2015 because they were going through a merger, which I talk a little bit about, but it actually failed to go through. And so here I mentioned when the charted, it does show that in the past 3 years the current stock has increased in revenue, which would indicate that it is healthy at this time. The stock free cash flow is positive by more than 25%, indicating that if needed, if need be, if they're not able to meet their earnings, their earning potential, they could actually pay out a little bit out of their free cash flow. And then their net income is a little bit below the 5% I would like to see, but this is kind of a long-term buy and hold. So price to earnings ratio is 13.93, where the current S&P 500 PE ratio is 25.75. Their dividend yield is 5.61%. Their annualized payout is 68 cents per share. Their payout ratio right now is 100%, and they've had dividend growth for 0 years. Now, this is a bit of a risky play, and so I talk a little bit about here. So it is a risky play, but New York Community Bank Corp has been crushed lately after its decision in October 2015 to merge with Astoria Financial and failed. So they were going through a merger. They cut their dividend because they could no longer, due to certain terms in the cash needed that in order to complete the merger, they had to cut their dividend. And after the announcement was the merger, stock fell. So After the announcement of the merger, people looked at the financials of both New York Community Bancorp and Astoria Financial, and that didn't really set well with the shareholders. So their actual stock price fell by more than 23% over the next 3 months. The bank also had to cut their dividend from $1 to 0.68, so that's a pretty big change right there. And what they're currently sitting at is they just increased their dividend from 0.68 to 0.84, so they have increased their dividend by 1 year. So dividend growth has been 1 year right now, and going forward, just because they're no longer in that merger, I think this is a great opportunity. It looked like a risky buy, but they've actually have a long history of paying dividends. The only reason they did that cutback, which cut their dividend growth, was because the merger, but it did fail, and they kind of learned their lesson going forward. So their PE ratio we already talked about is 19.3. So this is undervalued by the market, and where many other stocks have been roaring. And, if you look up Chase, or what was it, JP Morgan, and a couple of those other stocks, their stock has been flying up. So I think this was a really undervalued buy in the banking sector. Its price to book ratio is 0.98, which means it is undervalued when compared to its assets. And then it is down 23.82 year to date, but I can only see the stock rising back up after it fell below its price to book value of 1. So I could see the stock going forward in the next 3 to 5 years going back up to around the $18 range, which is what I am expecting. It's at $12 right now, so if I hold on to the stock for the next 5-10 years, I could see the stock jumping back up and getting back into that $16 to $18 range very easy, especially with just the way that they're currently sat. Now, I myself, I bought 14 shares of ticker symbol NYCB for the unit cost of $12.47 per share. I had a cost basis. It was a cost basis of $174.52. This will add $9.48 a year in future dividends to my portfolio, and this is my first time buying the NYCB stock, and my future 12-month dividend stands at $2,128.88. So as I add additional stocks to my portfolio or buy shares averaged down on, this will increase my year in future dividends, or how much I add additional to my future dividends, and then what my current dividend stand will be in the future going forward. So that's kind of something. Every time I buy a stock, I thought about just writing up an article like this, talking a little bit about why I made the purchase, what I looked at. I also looked at their 10Q and their 10K, and I believe going forward they've actually hit the bottom of the barrel, and they can only go up from here. So that's what I'm looking at as a Centurion buy. So that is it for this video. If you found it interesting, go ahead and let me know in the comments below. If there's anything, I looked into it definitely a little bit further than this. I did read a little bit about their 10K, their 10Q, and kind of how long their CEO's been where it is. A lot of people talk really negative about the CEO who's in charge of it right now, how he drove the company down into what it is now. But going forward, I do think that this is a good buy, and it is risky as I stated, but this is only one of my few risky investments, so I think it is well worth it in the future. So that is it for this video. I want to thank everyone for watching up until this point. If you did like the video, hit the like button below. Please remember to subscribe for future financial videos. If you have any questions or want to say hello, please leave a comment below. And of course, thank you guys for tuning in, and I will see you next time. Have a great day. Bye.